All right, today we are jumping into the latest annual results from Frasers Logistics and Commercial Trust, or FLCT. And let me tell you, when you first look at their report, the numbers seem to tell two completely different stories. You've got one number that looks absolutely fantastic, and another, well, not so much, especially if you're an investor. So our job today is to decode this thing piece by piece and figure out what is really going on. Okay, so let's get right into it. The whole puzzle here really boils down to two key numbers that just don't seem to add up. You know, it's that classic situation where the headline looks amazing, but it doesn't quite tell you the whole story. And that's exactly the mystery we're going to solve.
And here they are. Check this out. On one side, you have the company's total return. You can think of that as its headline profit, which shot up a whopping 41%. Awesome, right? But then you look at the other side, the actual cash paid out to investors, the distribution per unit, or DPU. That fell by 12.5%. This, right here, this is the paradox we need to unpack.
So yeah, that brings us to the big question, the one we're all thinking. How on earth can a company report this huge jump in profit, but at the very same time cut the amount of cash it's giving back to its owners? It just feels wrong. But believe it or not, there's a logical answer buried in how these big real estate trusts actually work. So to get that answer, we've got to pop the hood and take a look inside the engine room. We're going to break down the performance, look at what went right, what went wrong, and see what's really driving these numbers. Let's start with the good stuff. So the good news is, the top line is definitely growing. FLCT's total revenue for the year climbed by a healthy 5.6%, going from around 447 million to 471 million Singapore dollars. So right away that tells us the core business, renting out their properties, is actually expanding. So, where did this extra income come from? Well, it turns out it wasn't just one thing. It was a mix. First, they started getting a full year of rent from properties they just finished building, like a big one at Ellesmere Port. They also went out and bought new buildings that are already generating income in places like Germany and Singapore. And on top of all that, their existing commercial properties over in the UK just perform better. So yeah, the business is growing. But if revenue is up, why are the payouts down?
And this slide right here, this is the problem. This is the big headwind. While their revenue grew by about 5.5%, their finance costs, which is basically the interest they pay on their loans, jumped by a massive 26.4%. You can see the squeeze right there. Management says this is because of higher interest rates on their loans and new debt from those acquisitions. Get this, the cost of their debt grew nearly 5 times faster than their revenue. Ouch.
Okay, this brings us to a super important concept for understanding REITs. That big 41% profit number, that's total return. It's an accounting number, and it includes things that aren't cash, like a change in the paper value of their properties. The slide has a perfect analogy. It's like your home Zillow estimate going up. It looks great, feels great, but you can't go to the grocery store and spend it. Distributable income is the real deal. It's the actual cash left over after paying all the bills, including those higher interest costs. That's the only money that can actually be sent to investors.
This table sums it all up beautifully. You've got the push and pull. On the positive side, the growth driver, new income from new properties. Simple enough. But man, look at those headwinds. They were pretty significant. You have the higher interest rates we just talked about. Then they had more empty space at a key property in Singapore. The weaker Australian dollar hurt too, since a lot of their rent collected in Aussie dollars was worth less when converted back to Singapore dollars. And finally, they just had less extra capital to hand out this year. When you put it all together, the negatives just overpowered the positives.
Okay, so with those pressures on the cash flow, the next question you have to ask is, how stable is the company's financial foundation? Is it shaky? To figure that out, we need to shift from their income to their balance sheet and look at a couple of key health metrics. First up is the gearing ratio. You can basically think of this as their debt level. How much of their stuff is paid for with borrowed money? It's at 35.7%, which is ticked up a bit from 33% last year, mostly because of that new debt for acquisitions. But, and this is important, that level is still way below the legal limit, which is up around 45 or 50%, so no major alarm bells are ringing here. The second key number is the interest coverage ratio, or ICR. It came in at 4.3 times for the year. Now, that is down from 5.0 times a year ago, which makes sense given what we saw with those rising interest costs. But what does a number like 4.3x actually mean for the health of the trust?
The interest coverage ratio is basically a safety buffer. It tells you how many times over the company's earnings can pay its annual interest bill. So a higher number is always better.
The drop from 5 times to 4.3 times means that safety cushion got a little thinner, but a ratio of 4.3 is still considered pretty healthy. It means their earnings are more than 4 times what they need to cover their interest payments. It's still a pretty solid position to be in.
Now, looking ahead, here's something you'll definitely want to keep an eye on. The trust has a big chunk of debt, almost $500 million, that needs to be repaid or refinanced in the next fiscal year. And doing that in a high interest rate world can be tough. But management has been upfront about it. They've said they're already talking to banks, and they're confident they'll get it sorted. How well they manage this will be a huge factor for their performance next year.
All right, so we've dug into last year's performance, we've checked the financial health. Now let's turn our eyes to the future. What's the game plan? What does management see coming down the road? This should give us a really good sense of where FLCT is trying to go. This chart gives you a fantastic snapshot of the business as it stands today. You can see that about 2/3 of their revenue comes from logistics and industrial properties. We're talking warehouses, distribution centers, that kind of thing. The other third comes from their commercial portfolio, which is mostly office space. And this mix is no accident. It is very deliberate.
And here's that strategy in their own words. Management is making a clear bet. They're actively trying to grow the logistics and industrial part of the business even more. Why? Because they see it as being more resilient and having better growth prospects. This totally explains why all their recent purchases have been warehouses and logistics parks. They are tilting the ship towards what they believe is the stronger market.
And their own outlook for the market perfectly explains why they're making this move. Just look at the pattern here. In Australia, industrial is stable, offices have challenges. In Europe and the UK, logistics is resilient, while the office market is a mixed bag. In Singapore, muted demand for business parks, which are basically offices, but a healthy demand for prime logistics space. In every single one of their key markets, the story is exactly the same. Logistics is strong, commercial is weak. Their strategy is a direct response to what they're seeing on the ground.
And all of this brings us to our final question. We've seen the battle from this past year, a growing portfolio and a hot sector, but it's being held back by the global headwind of rising interest rates. Their strategy is clear, double down on logistics. But the challenge is just as clear. Can the growth from that strategic pivot create enough new cash to finally overcome the pressure from their financing costs and start growing those investor payouts again? That is the question for FLCOT in the year ahead.